you doing, folks? Mark Dutram coming to you with BayView Views. I want to come to you with a short commentary, especially in spite of all of the volatility that's been happening in the markets. And we don't like to watch it every day, and we don't want you to watch it every day, but I thought some of this might be insightful. We're pretty proud to say that the portfolios have held up really nicely versus our benchmark and versus certainly the major market indices. And we'll talk a little bit about why. But, the same concerns that have plagued the market since the beginning of the year continue to do so. The Fed, which is finally employing contractionary fiscal policy or monetary policy, trying to get inflation under control. Certainly China, with its lockdowns and certainly causing a lot of the problems that we're seeing with even domestic U.S. companies now. And it's causing a lot of concerns and inflationary pressures. And then certainly Russia and Ukraine, again, its contagion effects and the possibility of kind of exacerbating the inflation issues as that continues over there. So we know we're in the mid to late stages of this business cycle. And the thing is, we don't know how long we can stay in one of these. We can stay in one of these periods for years. And so we're obviously watching that quite closely. But we also know that the economy is still quite strong in many respects. When we look at earnings, for example, we're coming to the end of the current earnings season, and we've seen solid revenue growth. I think was up about 14%. Earnings per share up about 8%. I mean, those are really strong numbers and a good sign. So really, folks, the market is just trying to determine, where should I price equities today based on 3 to 4% long-term interest rates versus 0 to 1%, long-term interest rates. When we look at employment, it's amazing today. I think there's 2 jobs or 2 vacancies for every person looking for a job. That's incredible. But this is also a significant labor, supply and demand disconnect that we've really never seen in our past. And so that has a lot to do with kind of the lower structural participation rates that we're seeing today in the economy. With regards to growth, growth was negative in the first quarter. But a lot of that was, again, what we call supply or inventory spend down, and then also net exports. So we imported more than we exported. And of course, that's a negative with regards to GDP. But if you look at business spending and consumer spending, it was still quite strong. And so I think, even if a lot of people talk about recessions today, even if we see a recession, I think it'll be quite mild and certainly won't be very long lasting because, again, we're coming from a position of strength. And you see that today, certainly in the global PMI and services, manufacturing numbers that are out there. When we look at the consumer, we know the consumer sentiment is soured some, and certainly I think we just hit an 11-year low. And remember, that's their perception of how the economy is performing in the future. And it's been, not very good, but their spending has not followed suit. And so that's what we're watching quite closely because remember, that is 70% of GDP is the consumer and their spending habits. So we're watching that. It's a very significant metric. Monetary policy, right? So now we move to a more contractionary. But I would remind you that the 8 rate hikes that are now predicted and forecasted are already priced into the market, right? So the 2.8% Fed funds rate at the end of the year is already priced in. So hopefully we'll see some pleasant surprises to that. But again, even if they are that aggressive, it's already in there. And the Fed obviously is trying to balance full employment and inflation has obviously been quite hard to tame, and so we'll see what ends up happening with that. But the Fed should certainly not feel uncomfortable moving rates to a neutral position at certainly this time in the economy. The economy, again, is in pretty good shape. So finally, when I think about this year is midterms, and there's a really good probability that you'll see more of a balanced Congress, right? And the markets like that. It likes the checks and balances that come from a two-party system. And so that kind of bodes well for returns this year. So again, if you looked at our portfolios, which have the factor weighting, so we're overweight to, the price premium, the size, the profitability, they're holding up really quite well. As of the shooting of this video, I think the S&P is off about 15%. What's interesting is if you looked at large cap growth, which we've been saying is way overpriced, right, is off about 24% year to date versus large cap value, which is off 7%, right? That's incredible, right? And then if we looked at, large cap growth, even with its sell-off, it's still trading at about 23 times earnings versus large cap value, which is trading at about 14 times. So these are really large differences, friends, that really bode well for our portfolio and our investment philosophy. So I hope this information is helpful to you. As always, if you have any questions or concerns, we encourage you to kind of reach out. We love this kind of stuff. We're watching and monitoring the macro environment and the portfolios all the time. So we're here watching it so you don't have to worry about it, right? But again, if you have any questions, please reach out. And guys, as always, have a great day.